Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. Bear with me for just a moment. One quick thing I need to take care of on the sidelines. But today, I think we're going to be having some fun. I have something special planned for today. I'm going to be taking us through a little bit of a progress assessment. We're going to be taking a pop quiz. So those of you who consider yourselves fairly knowledgeable options traders, get ready. I'm going to put that to the test. I'm going to be asking you 10 questions about the world of trading options. And then what I'd like you to do is keep track of how many of these 10 you can answer correctly. And then we're going to give you sort of a scale at the end to see where we are from beginner all the way down to mastery. And I'll have some next steps for you after that. Should be a really good discussion here. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting in around the country out there on YouTube. Great to see Janelle and Josh, Jim, Eva, Jack, Helena, Dwayne, Humberto, everybody else. Thanks for joining us week after week. I really do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive, well, enjoy the presentation, but be aware that you are invited to join us in this live webcast. This is a Tuesday webcast series. We kick things off promptly at noon Eastern. We'd love to have you here in the live stream audience. And as a special treat for my live stream audience members, I have my very good friend, Scott Thompson, hanging out in the chats with us. Scott's going to be addressing any questions that I can't get to just during the flow of the presentation. Scott and I have now worked together for more than 20 years. Yeah, we go way back. Scott brings a lot of experience to this discussion. Thanks for having my back there, Scott. And I'd like to also ask you, give me a follow on X, if you would. You should be following your favorite presenters there on X. If you have an account on that platform, follow your favorite presenters. It's the best place to connect with them in between these live streams. So you can find me there at Cameron May CS. But as we get into this pop quiz, let's just call it our options trading knowledge quiz. Of course, we need to consider the risks associated with trading options and other approaches to markets. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today. As I mentioned, we're going to be going through an options knowledge quiz. So I want you to put yourselves to the test. I hope that this is going to help you to benchmark where you are in your own personal progress along your own personal learning curve. So I'm going to be asking 10 questions, starting, number one is going to be the easiest. Number 10, probably the hardest. So we're going from beginner out to what I would consider to be intermediate. And then I'm going to explain along the way. Of course, I'm going to be providing the answers, giving some demonstration of why those answers are what they are, using the Thinkorswim desktop platform. And then at the end, I want you to tally up your score. And then I've put together a little bit of a guide, whether we might consider ourselves to be beginner, somewhat intermediate, maybe we've read history of these introductory options concepts. And then I'm going to give you next steps for what you might work on based on where you are along your own personal learning curve. I think this is going to be a really valuable discussion for a lot of people. And if not, maybe just a bit of fun. So let's go. Janelle, you think you're ready? Okay, let's get to it. By the way, each of these questions are going to be what I would call binary in nature. It's going to be yes or no, true or false. I'm not going to ask for any essay responses. Not even going to hit you with multiple choice A, B, C, or D, or combinations of the above. We're not going to go that far. All right. So, Josh, there you go. Yeah. TF. Let's see how close you are. Anyway, so let's just bring up the platform and let's just stare at the chart of Apple for just a moment. But here comes question number one. True or false? This is a true or false question. A call option gives the buyer the right to sell shares at a specified price. Ding, ding, ding. Let's play the background music. I was about to do some background music I probably shouldn't use. Anyway, what do we think? A call option gives the buyer the right to sell shares at a specified price, true or false? Some of you are going, I got this. Others might be brand new to options trading, and they're like, I don't know what a call option is. What is that? Okay, answer is, for those who know anything about options, yeah, absolutely false. A call option actually gives the buyer the right to buy shares at a specified price. Now, the way that I think about this, if you've never really dealt with options before, let's say you're looking at Apple right now, and you're trying to decide, well, should I buy shares of Apple? Maybe what I'll do instead is get into a contract with another trader. This is the concept with another trader where I don't buy their shares from them, but I pay them for the right to potentially buy their shares from them at some future date at a specified price. We refer to that as a call option because we have the option to buy shares. And maybe in the old days, if you want to think about it this way, you might have called them on the phone or called your broker on the phone and said, hey, I want to exercise that option. All right. So that's question number one, some pretty light lifting. I would guess the vast majority of you just got a little check mark in the correct column for that question. Here's question number two. True or false? Buying a put option is a bearish strategy. What do you think? See if you can go 2 for 2. True or false? Buying a put option is a bearish strategy. That is true. Guess what? Who was it that put in the series of TF, TTF? You're 0 for 2. Yeah, buying a put option is a bearish strategy. Again, here's where a trader might think the stock is likely to go down in price. Let's say that our trader is looking at this. They remove this drawing, and maybe they see Apple going down, and they think it's come up recently, bumping its head up here at 210, and they think it's likely to head down further. Now, there is a strategy in stock trading where we might enter into a bearish trade. Not going to talk about it. It could get me a little bit off path, but I will say that it's a strategy that includes unlimited risk potential. So instead of doing that, maybe what our trader does is they decide, you know what, if the shares go down in price, it might be nice to have the right to sell shares at a higher price. Buying a put option provides a contractual right to sell shares at a fixed price. And the further down those shares go in value, having that locked in sales price can become more and more valuable to that trader. So yeah, question number one, false. Answer to question number two, buying a put option is a bearish strategy. That's true. All right. I think a bunch of you are probably 2 for 2. Let's dial it up just a little bit. Number three, question number three is a yes or no question. The strike price of an option determines the price at which the option can be exercised. Yes or no? Strike price of an option determines the price at which the option can be exercised. And the answer is yes. So let's change our scenario here again. Let me remove this drawing. Let's put in the original scenario where maybe the trader sees a stock that's been going down, but maybe it's starting to break to the upside, and they think maybe we're going up to these previous highs. And so they go buy a call option, as we've discussed. Let's go to our trade tab. And how about we go out here? Let's make sure that our trader is buying an adequate number of days, give them time to hopefully make that move. I'm going to go out here to the 19th of September of 2025. Let's go down our option chain. And let's choose from this column titled strike. Now, the way that I think about strike is that I'm striking a deal with another trader to potentially exchange shares of stock. In the case of a call option, we're striking a deal that allows me to buy shares at the strike price. So if I were to choose, for example, with the stock trading around 248, how about we strike a deal by buying a call option that allows the buyer, let's put ourselves in that role for just a moment, at that 240 strike. If I pay the $22-ish through the 19th of September, we would now have the right to buy shares for $240 per share. And if those shares went up in value, that's great. We still have the right to buy shares at 240. If they're worth 250, or 260 or 270 or 280. The higher it goes, the more that contract can gain value. Okay, Derek says, I was thinking an option could be exercised at any time for the strike price. That's true, it can, Derek. Yep, that's not one of my questions, so you're not creating a spoiler here, but it's a good one. Can the buyer exercise contracts on American style options? Hey, I just threw something out that's maybe a little bit more advanced, but yes, on stock options, the owner of that contract, in this case, a call contract, does have the right to exercise options before the expiration, all the way up through and to that expiration date. Now, I will say it's generally not in their mathematical best interest to do that, but they have the right to do it. All right, so that's question number 3. The answer is yes. The strike price of an option determines the price at which the option can be exercised. Let's dial it up a little bit more with question 4. Number 4, true or false? Selling a naked call option has limited risk. I just talked about a stock strategy that has unlimited risk. So options traders might think, hey, let's take a step into the options realm where maybe we can limit the risk on a trade. So does selling a call option have limited risk? Selling a naked call option has limited risk, true or false? The answer there is false. This is one of those strategies where it carries unlimited risk, and we need to understand that because unlimited is unlimited. We can't define how much risk there is, so we just have to say unlimited. Here's the reason. If we were to buy this $240 call, on the other side of that contract, there's someone who's selling that call to us. And with that, they're taking upon themselves the obligation to provide those shares to us. So if I have, let's say I bought these shares for $240, we have the right to buy shares for $240. Well, if someone else has an obligation, the seller of this contract has the obligation to sell those shares to me for $240. But what if they don't own the share? Maybe they've taken this almost sounds illegal, doesn't it? Has anybody ever thought, is that even legal? Yeah, it's legal. It's not allowed in every type of account. In accounts where we don't have the capacity to cover that risk, for example, in a retirement account like an IRA, where we can only contribute so much money to the account, can't take an unlimited risk in an account that only has limitations on how much cash can go into that account to cover things like risk. So, this trader who has sold us this call contract has unlimited risk if they don't own the shares already. Because what if those shares go up to $260 and I say, okay, well, let me buy those shares from you. The seller of that contract is going to be scrambling. Oh no, got to go get some shares. Ooh, I've got to pay $260 for the shares that I have to sell to Cameron for $240. That's a $20 owie, right? That is risk. And guess what? It doesn't stop at $20. If the stock goes higher, if it's at $300, if it's at $400, if it's at $500, they might have to go buy those shares at that higher price and then sell them according to the terms of their contract. That is a naked call position. It means they don't own the shares that they agreed to sell to somebody. That comes with unlimited risk. So I got a question out here. How should I identify that stocks derivative which can give profit while buying call or put options? Is there any good strategy that exists? It's a big question. It's not one that I'm going to get into today, but I do have some suggestions at the end for what traders might do to get a little more robust understanding of these strategies and then where they might expand to next, because I have a series of lessons that can help with all of this. But then there are other resources available from Schwab Education that can go well beyond the scope of just that series of lessons that I put together. All right. So lesson 4, question 4, true or false, selling a naked call option has limited risk. That is not true. That is false. Okay. Question 5, yes or no? If a trader sells a cash secured put, we're going back to the realm of puts, and the stock closes below the strike at expiration, they may be assigned the shares. So yes or no, if a trader sells a cash secured put and the stock closes below the strike at expiration, they may be assigned the shares. Yes or no? This one's a little bit tougher. There's a subtlety to this one. But the answer is yes. Yeah, they can be assigned the shares. And as a matter of fact, I would extend that to almost certainly they're going to be assigned the shares. When we sell a put, when a trader sells a put, what they're doing is someone has the right to sell shares to them at a specified price. If the stock below that, if the stock closes that final day on the contract below that price, let's say that we sold a 240 put on Apple. Someone has the right to sell shares to us for 240. And at expiration, the shares are only worth $230. Well, guess what? The owner of that put that we sold can't get $240 from anybody else. They now have the right to sell shares to us for a higher price than they're worth anywhere else. Are they going to do that? Almost certainly. I have to say almost certainly because it's still within their power if they want to call up their broker and say, hey, do not exercise. Every once in a while, somebody might get a wild hair and do that. But yes, almost certainly we're going to get assigned. That's why the question is phrased very carefully. You may be assigned the shares. Almost certainly will be assigned the shares. There's a tiny chance that that trader won't be assigned the shares. All right, Salient Joe says, I've been assigned when the price closed by 1 cent below the strike price with a put. Yep, that's a possibility. Ooh, let me throw out a question 5B. Yes or no? Yes or no? Can a put contract where the price is above the strike price be assigned? Yep, that can happen too. All right, there we go. So, Kay, you asked a question that's a little off track from this discussion. I don't go off track in my discussion, so my apologies. I'm not going to go deeply into the answer to your question, but I will give you some resources that will explore that, okay? All right, so the answer to question number 5 is yes. If a trader sells a cash secured put and the stock closes below the strike at expiration, they may be assigned the shares, and again, almost certainly will. Number 6, true or false? We're going to dial up the difficulty level a little bit more. We're venturing into the world of Greeks. Greeks can be a little bit intimidating, I think, for some new learners of options. Don't be intimidated. I'll show you how to learn this stuff. But true or false? When implied volatility increases, options premiums generally increase. But pardon me, decrease. Let me read it again. When implied volatility increases, options premium generally decrease. True or false? What do you think? I try to stall here to give you a little bit of time to process my question, provide your response, or at least jot it down at home so you can keep track of your answers that you're providing. Are you 5 for 5 so far? Are you 0 for 5? Okay. The answer is, as a lot of you are chatting in, Juan and John and Tom and Layla and Sharon, that is false. Yeah. When implied volatility increases, options premiums generally decrease. False. They generally increase. Let me explain why options prices typically go up as volatility increases. Options buyers, options demand is closely correlated, not exclusively determined by, but closely correlated to the volatility of the underlying security, like the stock. If a stock is expected to become more volatile in the future, and thus the phrase implied volatility, the expectation of future volatility, that can drive up demand for those options and drive up prices. When traders expect a stock to become more volatile, speculators in that stock might see that as potential. A stock that can move around a lot can be more attractive to potential buyers of put options, of all options, calls or puts. A stock that can move around a lot can be more attractive to speculators because that seems to carry more potential on a day-to-day basis. That can drive price up. Now, an expectation of increased volatility can also be scary to some traders. Maybe there are some that hold big positions of that stock in their portfolio, and they're using the options as a hedge. Well, when things are getting choppier, it may cost more to reduce the risk using options. So hedgers may drive up demand, speculators may drive up demand, but increasing implied volatility, expected volatility, will tend to increase the premiums on those options. All right. So number 6 was false. Okay, number 7, true or false? We're going to get into combination strategies now, not just calls, not just puts, but combinations of buying and selling calls and puts. So true or false? A vertical spread theoretically limits both trade risk and potential reward. Holly's saying I'm just complaining because I don't know the answers. That's okay. That's all right. Regardless of how many of these answers someone knows or not, I'm going to tell you where you might start or where you might move to next based on however many questions you answered correctly. All right, let me read it one more time. A vertical spread theoretically limits both the trade risk and the potential reward. That's a true question. And some of you might have been tempted to say, well, what are you talking about? Credit spreads or debit spreads? Are you talking about call spreads or put spreads? All types of the above. Vertical spreads theoretically limit risk and reward. I have to say theoretically because I know traders and I also know how these vertical spreads can play out. And there are things that can change this. For example, if we have a vertical spread and the stock happens to fall between our strikes at expiration, it might result in assignment on shares. We might wind up long or short shares of stock, and that can change the potential outcome of that trade. Another thing is that if traders tinker with the original trade, if they get out of the long or they get out of the short position somewhere along the way, that can change the reward and risk potential. So there are reasons why we have to say theoretically limits risk and reward. But yeah, a vertical spread has limited risk and limited reward because we have the right to buy and sell shares on the same stock for the same period of time, and that typically limits reward and risk. All right, let's see. Bruce, you're asking, maybe that would be a question for a future discussion. I'm going to park that one in my potential future webcast ideas. All right. So number 7 was true. Vertical spreads limit both trade risk and potential reward. Here comes question number 8. It's a yes or no question. If a trader sells a put credit spread, they want the stock to fall below both strikes at expiration. One more time, if a trader sells a put credit spread, they want the stock to fall below both strikes at expiration. While you answer that question, let me set that up. Let me come up here to our spread single. Let's change that to vertical. Let's maybe look at these 19th of September. It's over here on the put side of things. And how about we say we sell the 220, 230 put spread? Just as an example, right? All right, quick answer. If a trader sells a put credit spread, they want the stock to fall below both strike prices at expiration. The answer is no. They actually want the stock to be above both strikes at expiration. If we were to sell the 220, 230 put vertical spread, what we're actually doing here is we're selling the 230 put, buying the 220 put. When we sell the 230, we have someone has the right to sell shares to us for $230. Buying the 220 gives us the right to sell those shares on to somebody else for $220. Do we want to buy shares at 230 and sell at 220? That'd be a $10 loss. No, what we're pursuing actually here is the credit received. In this case, it looks like it would be between $305 and $355, maybe $3.30, $330 on that spread. And what the trader is looking for is hopefully for both of these contracts to expire worthless. Puts expire worthless, if the stock is above the strike prices at expiration. Still a chance, a small chance that that the contract might be assigned even if it's out of the money, just unusual. There we go. Oh, do we have a survey? That's excellent. Okay. So answer to question 8 is no. They actually want the stock to stay above the higher strike. Now, Eva, thanks for calling out that survey. Let me hit the pause button on my quiz for just a moment. We have 2 questions left. But it's not every webcast where we get the opportunity to give the presenter some feedback via these very short surveys. If you've never filled out one of our surveys before, it's 2 multiple choice questions, literally like click, click, and you could be done. Or there's also a comments box and a suggestion box if you want to provide me some more specific information. What I would ask is that you please fill out that survey. So click on that survey link and then fill it out when the webcast is over. What I promise in return is that if you take the time to fill out that survey, I'll take the time to read through your comments. I read through that data, and it definitely helps. All right. So thanks for doing that. Thanks for pointing that out, Eva. On to question 9. All right. Question 9 is a true or false question. True or false? And let's switch up our spread here. Let's set this back to single. And let's look at actually, let me show you one quick thing here. Right now, I want to talk about delta. It's not being shown. So let's click on where it says last price, net change. Let's choose our Greeks here. And I want to look at this delta that's around 50 on either side. True or false? A delta of 50 means the options price is expected to move 50 cents for the next dollar move in the stock. Now that's 50 cents up or down. True or false? A delta of 50 means the options price is expected to move 50 cents for the next $1 move in the stock. Now that answer is true. Yep. For those who understand the Greeks, we look at delta, and delta can mean a couple of things here. Delta, number one, can tell us the approximate likelihood that a contract will expire in the money. It will retain at least 1 cent of value at expiration. That's one potential interpretation of delta. Another, and this is the way that I think about it, delta starts with D, so does dollar. And a delta of 50, let's just imagine this is 50 and not 54. Okay, doesn't matter. Same concept. If we have a delta of 50, delta can also tell the trader to a precise degree of accuracy. What's expected to happen with the value of their option if the stock goes up or down $1? That's why I say delta starts with D, so does dollar. So if we were to buy this call, let's say we pay, let's call it $17. All right. Let's say we buy that for $17, and then GE goes up $1 very quickly. So there's no other variable at play here. So time hasn't passed. Volatility hasn't changed. We talked about how volatility can change the value premiums. Let's just say very quickly, GE pops up $1. Well, our delta would tell our new value of that contract should have moved from $17 to $17.50. It's very precise as long as it's the only thing impacting our option value. So yes, if the stock drops though $1, how much would we expect our option to lose in unrealized loss? It would be expected to drop 50 cents, or in this case now it'd be about 55 cents. So yes, number 9, true or false, delta 50 means the options price is expected to move 50 cents for not every $1, but the next $1 move in the stock. That answer is true. Now the final question. Gonna have to do some math here. It's just a yes/no question. But yes or no, if a trader pays $2 for a 45/50 bull call spread, a 45/50 bull call spread, the maximum possible profit is $5 per share. What do we think? I'm going to see if I can find an example here that I can teach from. Let's change this back to a vertical. Oh, look at that right there. It's actually, no, let's find a $2 spread. There, good. problem with that with GE here. I say Apple earlier. This is GE. Anyway, nope, it's not going to work for me because the strikes are too wide. Anyway, matter of fact, I might flash over here to Apple and use it. Go down here. Let's look at maybe this one. Yeah, let's look at that one there. Close up September. Let's stick with August. There's one that's about $2. Dragon Rider says, I'm lost. So Dragon Rider, we're just doing a quiz. I know that you said you showed up a little bit late. We're just going through 10 questions. We started with the easy ones, and you happened to hop in on the harder ones, so I don't fault you. Everybody's somewhere on their own personal learning curve with options, but we've been getting a little bit harder with our 10 questions. In any case, so the question was, if a trader pays $2 for a 45-50 bull call spread, the maximum possible profit is $5 per share. The answer is no. Max profit is actually $3 per share, which is the width of the spread minus the premium paid. So in this case, let's look at this. Here's a $5 wide spread. These strikes aren't the same as the one that I proposed. Instead, it's a 210, 215. Same concept, though. It's a $5 wide spread. And in this case, what we would be doing if we are buying a bull call spread, that means that we're buying the lower strike, selling the upper strike. That would give us the right to buy shares for 210. We'd have an obligation to sell shares for 215. If those contracts are exercised and assigned, we buy shares at 210, sell at 215. That would be a $5 profit if this were a free trade. It's not a free trade. Vertical spreads cost money. How much? Well, we said about $2. All right, this right now would be about somewhere between $2.15 and $2.30. Let's say that we got super lucky with our fill and we were able to buy this for $2. So it cost us $2 to set up a trade that can turn into $5. Well, that leaves $3 as potential profit. There you go. All right, so that final answer, yes or no, if a trader pays $2 for a 45-50 bull call spread, the maximum possible profit is $5 per share. The answer is no. There we go. There are our 10 questions. I'm going to rattle back through these just very quickly. I'm going to give us a little breakdown. And believe me, there's nothing scientific behind this. It was just the way that I view things. I put this together myself just this morning. But in any case, number 1 was false. Number 2 was true. Number 3 was yes. Number 4 was false. Number 5 was yes. Number 6 was false. Number 7 was true. Number 8 was no. Number 9 was true. Number 10 was no. Eva, you like this? Good. All right, so here we go. Let's tally up how many we got right or wrong. Let's talk about the number we got right. Okay. So if we're somewhere between 0 and 4, what does that say about us as an options learner or a beginner? So I just described that as a beginner. The learning has just begun. And I do have a suggestion for what you might work on next if that's you. I've actually put together a series of lessons to help beginners learn about options. And it's found on our Trader Talks Schwab Coaching webcast page on YouTube. So if you haven't done this already, I'm speaking especially to you beginners who haven't subscribed to our channel yet, go down the lower right-hand corner and click on the subscribe button right now. It doesn't cost anything. It only takes a second. But our YouTube channel is where we house our previous webcasts. And included in that are all of the playlists for all of our webcast series, with a few exceptions. We have a bunch of webcast series, but you can find them all right here. And the one playlist that I want to introduce you to is right here near the top. See where it says start here to learn about trading options? Just click on view full playlist and you'll see 10 lessons. And what I would suggest for you is if you are a beginner and you scored between 0 and 4, start right there at lesson 1. Every single one of these questions that I just asked is addressed in detail in this lesson series. So lesson 1, trading options building block number 1, long calls is a great starting point. Now, if you happen to get 5 to 6 correct, rather than a beginner, I'd say you're more of an apprentice. You're making good progress, but still have a ways to go in the learning process. If you've already been through lessons 1 of 10, this is where I think things are likely to start breaking down. It's probably really understanding the pricing of options, the Greeks, and using combination strategies like vertical spreads. I would guess a lot of those that got between a 5 and a 6 probably knew what the long puts were, or knew what the short puts were and the long calls and those sorts of things. Start at lesson 5 if you've already been through the first 4. No harm in going through the first 4 again, even if you've been through those. But this will introduce the vital role of options pricing and the Greeks, and have us prepared for building combination strategies. So if you got 7 to 8 correct, I would consider you to be kind of an intermediate learner. So we've gone beyond beginner and apprentice. Now we're starting to gain some confidence in our knowledge, and it's time to go deeper. This is where we'll start building those combination strategies. I would guess that you probably got tripped up in combining short calls with short puts, short calls and long calls, short puts and long puts. So might be time to prepare for more strategy refinement with just plain old single leg option strategies. Go through lessons 6 through 10 if you need to revisit things, but also it might be time to learn about charting. Somebody asked a question that I think is going to be answered with my other webcast series. So I'm going to flash over to a different webcast series here. Let's hit the back button, go back to our playlist, and I'm going to scroll down closer to the bottom. Right over here, advanced charting techniques. This might be a good next step if you're quite comfortable with option strategies, but trying to work on the timing. Now, technical approaches isn't a guarantee that we're going to have success with our strategies. But if you're starting to round out your understanding of just trading and investing in general, that could be a good next stop, advanced charting techniques. All right. You might also use your own discretion to work your way through, if we were to go back to the original playlist. Oh, actually, let me do this. Scroll all the way to the bottom in our playlist. This is for you that are kind of intermediate. Maybe explore your, where did I put that thing? Getting started with options. There it is with Barb's face on it because she filled in for me last week. You can start to use your discretion to look through this webcast series, because we go beyond just the 10 lessons, and we start to explore these strategies and combine them with technical charting approaches and things like that. Okay, so 7 to 8 is intermediate. 8 to 9, correct. I'd kind of label you as a journeyman. Now, this is somebody with some experience. They've even been applying these concepts. So you really are prepared now for more strategy definement, looking at the other webcasts that are available. And I might suggest maybe look for an advanced options webcast, maybe look at that advanced technical analysis series that I just mentioned, and come back and make sure that you're still keeping an eye on this webcast series. There's still a lot to learn. Now, finally, if you got 10 correct, congratulations, that's fabulous. I would say that you have mastery of the concepts that we covered in those first 10 lessons. I think here is where you add strategy and get repetition. Everybody should probably be doing some paper money trading of the concepts as they learn. But yeah, maybe round out what the possibilities are with options trading. And that could be, again, looking for an advanced option strategy series. Continue to watch this series. So, for example, last week, this is interesting. Brent took a deeper dive into the guide to options Greeks. Before that, Barb discussed a strategy known as buy right covered calls, which is entering into covered calls, buying the stock and selling the call at the same moment. The week before, Connie talked about legging into covered calls, buying the stock and then selling the call at a later time. But when we've reached that mastery level, it's time for adding new strategies, getting repetition with existing strategies, And then one final thing I would suggest, and I think a lot of you could agree with this, when we've achieved what we think is mastery, one way to discover if we're fooling ourselves is try to explain the strategy or the process to someone else. That can really help us spot the holes in our understanding. Okay, guys, I hope you enjoyed this discussion, whether you're a beginner, apprentice, intermediate, journeyman, or you've achieved mastery of the 10 lessons that I've put together. I thought this was going to be a fun exercise, and I think that's what it's turned out to be. So it's time for me to let you go. We'll get back to sort of normal, putting these strategies into practice next week. I hope that you'll join me then. In the meantime, make sure that you are checking out our other webcast series on our channel. If you haven't subscribed to the Trader Talks channel, make sure that you do that now. Go down and click on the subscribe button. Also, make sure that you're following your favorite presenters on X. So let me bring that up here for you. If you want to track me down on X, you can find me at Cameron May CS. Make sure that you are precise with that handle. That this is the guy you're looking for. This is the best place to connect with me in between these live streams. Love to have you there as a follower. Also, thank you to everybody who's already clicked the like button. We have 142 people watching the live stream right now. 54 have already clicked the like button. I don't know if you understand how much that's appreciated. When you click that little thumbs up, it's a pat on the back to your presenter. It's like a standing ovation for the hard work that goes into these things. It also gives my webcast a boost in the YouTube algorithm and helps more people find these things. And I think this is going to be an important one for people to find and watch to assess where they are and what steps they might need to take next. So thanks for clicking that like. All right, time to fill out that survey. Thank you, Scott, for reposting that. I will see everybody next Tuesday for another discussion of getting started with options. I'll look for you in my other webcasts in the meantime, and I'll also look for on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.